What happens when the world's largest asset manager suddenly abandons the very word it spent years drilling into every boardroom on the planet? You don't erase a global agenda because it failed. You erase it because it already did its job. ESG was never a moral mission. It was leverage like a pressure system disguised as virtue. And the moment it turned politically toxic, BlackRock didn't step back. It shapeshifted. When a firm controls over $10 trillion, it doesn't need to issue commands. It only needs to whisper, and markets move. Votes tilt. Boards panic. Capital silently changes direction without a single headline. So the question isn't whether ESG was good or bad. The question is what new mechanism replaces it now that the old one has finished its work. BlackRock never needed majority ownership to influence global corporations. A consistent 5 to 7% position in the largest companies across the US and Europe gave it something far more potent than ownership: decisive voting power. The structure of modern index funds concentrated thousands of small investors' shares into BlackRock's hands, giving the firm the authority to approve or reject directors, shape governance frameworks, and tilt corporate strategy. ESG was the narrative that justified this influence. Companies framed it as moral alignment. BlackRock used it as a system of incentives and penalties. Align with ESG and access to capital stayed smooth. Resist it, and leadership stability, borrowing costs, and investor sentiment all became fragile. If you were a CEO, you understood immediately that this wasn't guidance. It was the equivalent of a loaded contract. Comply with the ideology of the moment, or risk losing institutional support in a market where liquidity can dry up overnight. You didn't need a phone call spelling it out. You saw it in proxy reports and voting recommendations, in the subtle language of concerns about long-term alignment. When a shareholder that large opposes your board slate, every other institution takes note. Suddenly, you're not just managing a business. You're managing a quiet, ever-present threat sitting on your cap table. Retail investors felt none of this. They believed they were simply buying ETFs, outsourcing complexity, doing the responsible thing for their retirement. In reality, their savings were quietly powering one of the most coordinated voting blocks in financial history. Millions of fragmented accounts turned into a single coherent voice. And that voice did not belong to them. The small investor carried the risk. BlackRock carried the vote. That's the kind of asymmetry that reshapes capitalism without anyone needing to change the law. Behind closed doors, the dynamic was even sharper. A board considering whether to approve a controversial project, a merger, or a governance change knew that one question mattered more than the press release. How will BlackRock vote? If the firm signaled that a proposal failed, ESG expectations, that proposal became radioactive. Directors weren't just afraid of reputational damage. They were afraid of being removed, of facing activist campaigns amplified by the silent blessing or disapproval of the biggest asset managers on Earth. ESG made this pressure look noble. It turned raw power into something that could be marketed as doing the right thing. It gave executives cover. They could tell their employees, their customers, even their voters, we didn't have a choice. The capital markets demanded it. In other words, ESG gave everyone a convenient story. BlackRock got leverage. Management got an excuse. The public got a slogan. But systems built on unspoken pressure don't stay unchallenged forever. There's always a point where someone with enough money and enough anger decides to push back. That moment came when this concentrated voting power collided with states whose economies are welded to oil, gas, and traditional energy. In those places, ESG wasn't a line in a report. It was a financial noose tightening around their tax base, their jobs, their political future. And when that voting bloc collided with political power in states built on oil and gas, ESG stopped being a corporate formality and turned into a battlefield. The next question became unavoidable. What happens when governments stop playing along and start fighting back against the asset manager itself? The backlash didn't come from fringe critics. It came from states with massive balance sheets and entrenched energy economies. Texas fired the first serious shot when its permanent school fund removed approximately $8.5 billion from BlackRock's oversight, claiming the firm's ESG stance harmed the state's economic lifeblood. Florida followed with a multi-billion-dollar withdrawal of its own, arguing that BlackRock's ESG priorities conflicted with the fiduciary duty owed to citizens. Soon, other states enacted restrictions preventing public funds from being managed by institutions perceived as hostile to traditional energy. This wasn't ideological noise. It was a direct assault against BlackRock's influence over capital flows. When states pull billions, the firm doesn't just lose fees. It risks losing political access, public mandates, and credibility in enormous markets. Suddenly, the ESG sword that once cut one way was cutting back. BlackRock faced a choice: escalate the ideological fight or adapt. What they chose next didn't look like surrender. It looked like evolution. And it raises a sharper question. How do you abandon a narrative without giving up the power that narrative created? While the rails debate plays out, another infrastructure story is moving behind the scenes. Let me introduce Unic, the platform that's changing the game in crypto trading. Unic's OTC exchange has already processed over $1.3 billion in OTC trading volume, giving both buyers and sellers the flexibility they need. With over 5.5 million active users and 500,000 plus followers on X, it's a platform built for scale. Please note that this is not financial advice. Larry Fink eventually said openly that he avoids the term ESG because it has been weaponized by both political extremes. His 2024 and 2025 CEO letters reflected that shift. No ESG rhetoric, no DEI language, no climate-first framing. Instead, he introduced energy pragmatism, a calmer, more neutral stance acknowledging that the global economy will rely on hydrocarbons long after the slogans fade. The tone shifted from ideological crusade to balanced transition. BlackRock stepped back from some climate alliances and softened its support for aggressive climate shareholder resolutions. At the same time, the firm expanded its pass-through voting program, allowing institutions and eventually retail investors to choose their voting policies. It looked democratic, but the infrastructure, research, and actual execution remained in BlackRock's hands. The firm wasn't relinquishing control. It was absorbing political shock. Voting power became less visible, less centralized on paper, but operationally unchanged. The narrative changed. The machinery didn't. The shift raises a deeper question. If ESG faded not because it failed, but because its job was done, what system is being engineered to replace it? Strip away every slogan. ESG, anti-ESG, energy pragmatism. And the structure remains the same. Global investors exert pressure from one direction, demanding higher governance and climate consciousness. Political forces in the U.S. push back from the other direction, rejecting anything that resembles ideological enforcement. Corporations are trapped in the crossfire. Asset managers like BlackRock position themselves in the center, adjusting language and optics to survive without ceding the influence their voting power provides. Programs like voting choice soften the appearance of centralized decision-making while maintaining control of the rails. Investors imagine they're uninvolved, but their savings, their index allocations, their retirement accounts are silently shaping policy, governance, and corporate direction. They think they're spectators, they're not. Their capital is fighting in a war they don't even see. Speaking bluntly, after watching capital cycles chew through empires, currencies, and entire sectors, I've learned one thing. Narratives are just camouflage for power. ESG was one costume. There will be others. If you don't start treating this system as a live battlefield where proxy votes, index construction, ETF flows, liquidity cycles, token unlocks, and on chain governance are all weapons, then you're not a player, you're collateral. My advice is simple and uncomfortable. Stop obsessing over daily price candles and start mapping who actually controls the rails your money runs on. From Wall Street stewardship teams to the whales steering liquidity in your favorite crypto pairs. Either you evolve into someone who understands these mechanisms and positions capital with cold, predatory intent, or you accept that your portfolio will keep silently voting for a future engineered by people who are perfectly fine, making their gains from your confusion and your blood in the market. Quick update on Unic. Their IDO for the UN token is live. The project markets a low FDV approach, referral rewards, and NFT perks for early participants. They present themselves as an on-chain OTC liquidity layer, aiming to capture pre-market and institutional flows. Again, not financial advice. Check the link in the description for Unic's token page and white paper before deciding. In the end, ESG was never the point. It was just one mask in a rotation of narratives used to steer capital, discipline corporations, and rewrite the rules without ever touching a ballot box. Now that the mask has slipped, the real game begins. Because when an agenda disappears, it doesn't die, it mutates. And the next version will be quieter, cleaner, and even harder to detect. So ask yourself one thing. Will you recognize the new playbook when it arrives? Or will you realize too late that your money was already pulled into the next cycle of control? Subscribe to Underworld Capital. Leave your thoughts below and stay ahead of the forces shaping the market long before the headlines catch up.